My name is Rob Eyler. I'm an economist for the League and also a professor at Sonoma State University. Thank you again for joining us today for the Credit Union League's look at the Bay Area economy and forecast. We're going to start with a question for our panel here. And what can members in the Bay Area do if they're concerned about their credit union in terms of coming to your credit unions? And Brian, we'll start with you.
Sure. Thank you, Robert. Thank you, everyone, for joining. And thank you to my colleagues for being here. I would say that, we always start with, we're a credit union. This is what we do. We reach out to our members and we do this on a one-on-one basis. So I would say, to the folks that are traditional credit union members, reach out to us, talk to us one-on-one, stop in at a financial center, give us a call, that kind of thing. We're always here to help and talk folks through it. So that's always there. And then, of course, for the folks that really want to dig in and maybe can read financial statements pretty clearly and that kind of thing, everything's there that really differentiates us from the others that have had, difficulty recently. And that information's out there, obviously, in our reports and call reports and that kind of thing. Where our investment portfolio stands on a mark-to-market basis, where our uninsured deposits level is at, and of course our net worth ratio, right? Because we always want to sell that as our buffer. So I would really start there for the groups on both sides, Robert.
Thank you, Harold.
Okay, well, I thank you to the League for having me here for this particular update. And two, as Brian said just a moment ago, we use multiple channels you can talk to someone in Uncle Credit Union. We're not, and I'm not bashing larger organizations, but we are intimate enough that if you want to walk in and talk to the CEO of Uncle Credit Union or any other executive or a board member, we are local. We're enmeshed within the community and through our various channels, through our social media channels, where if you want to chat with us, you're welcome to come in. We have a 65-year history here within the community that we serve. We're headquartered here, and our financials, we're an open book. We publish an annual report every year, and that annual report reflects, while we're not for profit, we do make a profit, but we are here to serve the membership that is there. I think it's about transparency, so to speak, and it's not an organization that's headquartered on the East Coast in the ivory tower. You have to go through public affairs to talk to someone. We're right here and we're available. We're here through multiple channels.
Thanks, Harold. Marito.
Well, I agree with both gentlemen. I think a lot of members have reached out, whether it's walking in person or through phone. And of course, there's a lot of information in our websites as well, as they've been talking about. But you can also reach out to the NCUA and find out about your local credit union and how strong we are. There are financial reports that they have available. And I think there's also, a mycreditunion.gov where they can find out about the NCUA insurance that's provided. I think many of our members throughout the past weeks have been asking about the NCIF, and they're now learning, that has the full faith and credit of the United States government, just like the FDIC. And I think there's a perception there that might be different, but it's exactly the same. And the insurance works the same way. And I think that's provided a lot of comfort to many of our credit union members.
That's awesome. Marito, let's stick with you for a minute. Let me ask a second question. What's the number one thing that you're hearing from your employees that members might be telling them about their concerns with respect to the Bay Area economy?
Well, I think there's really been two themes. The longer term theme has been housing and how expensive it is for many people to participate. And I know that in the last 3 years, a lot of people have seen housing inflation, especially for renters, where it's been really difficult. And rent has been increasing. That's abated somewhat in the Bay Area, so it's given them some relief, but it's still a good chunk of their take-home pay. And inflation, which is the second theme, has also eaten away onto that. So both these items, housing and of course now in high inflation, has been a big theme that many are concerned with. How do we make ends meet now that food prices have gone up? Energy prices, well, they came down a little bit, although now we're hearing that they're going to go up again. that's the concern of a lot of people on the ground.
Harold.
Well, I believe that inflation is and I think the media has done a great job about keeping it at the forefront for everyone. We are a moderate employer. We're not a Google or Facebook. Our employees, I worry about the financial health of our employees. I worry about the financial health of our members. We are a retail shop. And so for that, here in the Bay Area, as you've heard just a moment ago, housing is a very large concern. The cost of borrowing has increased more than almost tripled within the just recently. And so, when you want to buy a home, you want to refinance your home, you want to buy an automobile, credit cards, those borrowing costs have all gone up quite a bit. And I think that is a bit of a damper. And of course, as the media continues to highlight inflation, everyone's become a bit of an economist here, Robert, a lot more. And so I think that's been a concern that we hear for just about everyone. The cost to borrow, and we are a lender by choice. That's what we do first. And unfortunately, that's been, when you look back on history in the last decade, it's been a challenge to see how borrowing costs have increased. That's the concern.
Yeah, no, absolutely. And I'm going to show a graph in a minute just to watch that evolution over the last 40 years and try to think about how pressing it is of where we're going in our economy, but also just the way the Federal Reserve has handled the fight on inflation, how that's changed the trajectory of rates in a really wild way. Brian.
Well, to follow up, thank you, Robert, on that, as well as what Harold and Marito had to say. Right, a lot of that has to do with how the feds are reacting to things, and certainly with rates moving up, now we're all fighting for deposits again, right? So folks kind of got used to getting nothing, or close to nothing, right? And now all of a sudden things move overnight. So what's the expectation? 1% on your money, 2%, 3%, 4%? That's a long way from zero. So I think that not only the rate on deposits, but the safety of deposits, right? The safety of the banking system as a whole. These systemic things that we've seen recently. So I think overall, there's really a risk-off mentality right now, kind of thing. And I think people want to find a safe place, safe haven, right? Like the money, right? We're seeing lots of, plenty of money moving into the money markets and that kind of thing.
Yep.
Folks just want safety for some period of time. Just give me someplace safe to put my money. I'll know it'll be there tomorrow. And at some point, maybe I'll reinvest into something more lucrative.
Yeah, and we kind of had to expect that was going to happen, right? At some point that dam had to break, and people are going to say, well, I can either earn half a percent here, or I can go earn 3.5% in the money market mutual funds. What's that mean in terms of the shifts of deposits and the cost of funds, and ultimately what's that mean for the solvency of banks and credit unions? And we've seen that now tested. Folks, that's a great start. Thank you so much. What I'm going to do now is I'm actually going to do a quick transition to some slides about the macroeconomy and just try to show members and credit unions some things I have to think about when we think about the Bay Area economy as well. But I'm going to start with kind of a macro slide we just talked about. So if you look at the 40-year run since 1982, in terms of two different perspectives on interest rates, the first one is the difference between the 10-year Treasury and the 3-month Treasury spread. And those shaded areas in this graph moving left to right are the most recent 5 recessions. So we came out of the double dip recession in 1982, almost 83. You can see that shaded area on the far left-hand side. And then we had the Gulf War I recession, the dot-com recession, the Great Recession, and then a very skinny recession, which will be forever linked to the pandemic period. But you can see that sort of cyclic evolution of that so-called long-term, short-term spread. And the reason I show you the 10-year and 3-month, because economists as researchers kind of feel like that spread is the most prescient of coming recession when that blue line goes below the zero line. And you can see on the very far right-hand side, it dove straight down because of 2 reasons. Is one, we're buying down the 10 years, trying to gain access to yield at the same time that the short-term rates are being pushed up by Federal Reserve action. Now, this is the Federal Reserve rate in terms of the so-called effective federal funds rate, or how the market uses the interbank rate once that range is set by the Federal Reserve. And you can see this slow evolution down for most of the 40-year period with a couple of nuances. One, started really high. So remember a time when inflation was very high, rates were very high initially to try to fight that, and then we fought it and we came down, and that slow progression down in trend is what we call the Great Moderation. It kind of follows the downward trend in inflation. And then that flat period that's after the Great Recession is this experiment with the so-called zero lower bound that we only really lifted off of in early 2015. We did this nice sort of step ladder up to the point where we cut rates 3 times in 2019, and then the sharp cut back down to the zero low bound in 2020, followed by this amazing change, almost vertical climb on the far right-hand side that we're now in with respect to the Federal Reserve. And so what I try to think about is how many headwinds does this really create? We know that rising rates have created profit margin squeezes for lenders, and we saw Silicon Valley Bank will probably be the poster child of what's happened, partially because of Federal Reserve policy and partially because of a rollback for regulation, lack of oversight, you name it. But that's coming. We have to expect some credit squeeze is coming. We know that the prime rate on the business side is directly tied to the federal funds rate. So what's that mean in terms of the cost of borrowing for businesses? And Harold alluded to this earlier. The overnight rate on the interest that we earn on overnight funds when our credit unions put their money with the Federal Reserve and kind of have it there as a prime buffer for members. For some credit unions, that's providing a relatively strong amount of revenue on a quarterly basis. For other ones, they did not have that much liquidity at the Federal Reserve, and now they're playing this game sort of chasing around funds. And this is also true in banking. Inflation should be slowing down. So when that black line goes vertical up, you should expect more downward pressure on inflation. And on Friday, the Federal Reserve's current favorite measure of inflation, which is called core personal consumption expenditures prices, clicked down 0.1% from the previous month's looking back 12 months. So that annualized inflation is slowly going down in trend, but it might not be going at the speed the Federal Reserve wants. So one of the big questions for credit unions, especially on the leadership side as we move through 2023, is will we see more rate increases and what's it mean? And there currently is no recession predicted yet, believe it or not. There is no consensus that we absolutely will go into recession. But what I try to tell people, it's not important whether or not we're going into recession. It's more important about the slow, sluggish aspects of the economy that pays for some of these things we're doing to try to fight inflation and how long that will linger, because you can have a very slow moving, positive moving economy. The Australian economy, for example, is a great example of this. They had 27 or 28 years straight with no recession, but the growth rate was very slow on average, except for some episodic jumps. So are we going into that type of a period where we're slow and low and never really have quote unquote recession? Or are we going to break out again because of some technological change or ways in which we finally turn the corner cyclically? We'll find out. Now, on the Bay Area side, the Bay Area Council's Economic Institute does an annual forecast. And I wanted to pull 2 nuggets out of that forecast as sort of prep for our meeting today, but also kind of thinking forward. One of them is the recognition that the Bay Area has recovered more slowly in terms of jobs. And I show this graph for every county in California when I talk to them. And also when we've done these in the past, I've shown this graph. Hard cut starting in February 2020 and then kind of going down to the bottom. You can see the California actually sunk a little bit more on a percentage basis than the Bay Area, but the climb was faster, and the US on average did not fall as far as the Bay Area did. When you think of the Bay Area as sort of the 9 counties of San Mateo, San Francisco, Contra Costa, Alameda, Santa Clara, Marin, Napa, Sonoma, and Solano counties. So that climb is slow for a large extent because we kind of followed the rules. We actually did all the restrictions. When you went between the mountains, not everybody was following that. And in fact, there's certain parts of California who kind of gave a wink to social policy and never really changed their sort of modus operandi in terms of daily operations. They actually recovered jobs more quickly than the Bay Area, and the Bay Area is still getting through some of that. You can see where the Bay Area is versus those other two toward the end of last year. We also have a lot of exposure to tech job losses and also to travel not completely coming back. The current forecast for California is we won't see a full return to travel until maybe 2024 or 2025. And we're getting concerned about what that means in terms of sort of businesses that depend on inbound commuters, conference travel, and things that have not quite come back to the Bay Area versus their pre-pandemic levels. That's something to think about, which then takes us to the final stop on this. Just quick overview of the nuggets I pulled out of the Bay Area Council's Economic Institute's forecast is on office vacancy. So we do have, I think, some reckoning coming in commercial real estate. And what that means ultimately for member business lending, for member jobs, and really for how members look at the future is something to think about. So these two columns, the green column is the vacancy rate at the end of 2019. The blue column is the vacancy rate across those geographies at the end of 2022. And you can see there's been a wild change, except basically for downtown Oakland, which is held firm. But for a lot of the Bay Area, there's been this struggle of whether or not people are going to come back to the office and what that means. And we have to imagine that at some point, small businesses that depend on inbound commuting are going to be hurt. And will that occupancy come back? It's kind of the question of the hour for a lot of the Bay Area, especially the urban part of it. And how much of that change in terms of going to work from home is going to stick around. So there's some strategic aspects that we have to be thinking about as credit union leaders, and ultimately that members are going to be thinking about the local and regional economy. So with that as a tee up, guys, let's come back and talk real quick about the Bay Area economy. What did you see, or what are you thinking about in terms of the forecast for the Bay Area that maybe gives you the most pause as a challenge? So, and Brian, we'll start with you.
Well, I think just seeing where the tech line goes here, right? The tech trend line. Your first chart there showed not only the interest rate cycle since '84, but my career since '84, right? So this is, you know, where I started, and then to see the ups and downs since then and all these cycles, and we got tech bubbles in there too, right? So here we are in basically a tech bubble. How big a bubble it'll be, how much it's going to hurt when it bursts, and that kind of thing will remain to be seen. But just reading today's paper, you know, we know that Morgan Stanley's got you know, quite a say in analyzing these types of things. I'm sure they read your stuff, you read theirs, and you know, Mike Wilson will be you know, he's piling on today, saying that it's inevitable. I can't disagree. Yeah. These things do go in cycles, and it's only natural. The only thing I can say, and you know, whether we can comment on this now or maybe later, Robert, but it's interesting in that first slide to think about where the Fed's been and that kind of thing. Maybe at some point we can talk about the actual manipulation by the Fed in recent years that I've never seen anything like it. And I think that's driving some of this yield curve too into abnormal areas. The size of the Fed's balance sheet in relation to GDP now versus any time previous.
There's a lot of consternation. Oh, sorry, go ahead.
No, I'm sorry. I didn't want to take the table for too long, but I'm sure you've got some thoughts, Robert.
All I was going to say was, there actually is a lot of economists starting to look more at the balance sheet composition of the Federal Reserve versus the federal funds rate and the rate environment they're setting through that instrument. So you nailed it. They become much more of a player, especially over the last 15 years, in terms of that sort of the yield curve manipulation, using their balance sheet to shape the yield curve. And that's also, I think, given a lot of investors and businesses pause, because they're not sure when the Fed's going to intervene and in what magnitude. Marito.
Yep. Well, I think, you know, two other, and you mentioned it. One is, you know, the commercial real estate, you know, the state of commercial real estate. Now, you know, the Bay Area is very diverse. I mean, I think, you know, there's some areas that are showing a little bit of growth, signs of growth, but others where it is shrinking. And commercial real estate is one area, whether it's office and hospitality, they're both reeling. And I think the vacancy rates are real. You know, I have a lot of folks I continue to monitor and ask, okay, you guys have a come in 3 days a week policy. Are you guys going in? And the answer is still not coming in, which again worries me, especially when you talk about the mom and pop businesses that support a lot of folks who go into work. And, you know, many of them have already folded, but those that have managed to survive may not last as long. So I think that there's the impact of work on the local economy has certainly shifted, where one would say for every tech worker you had, maybe 5 jobs created. That may be very different now, and the dynamic is changing. So I worry about what that does to the local economies and the folks that we support. So, you know, commercial real estate in the big picture, I think is a much larger story. Certainly you're reading it as something that could be that sore thumb that would impact a lot of the banking sectors. And I watch that very closely because that is going to be probably the other bellwether. If there's another shoe to drop, that may be it.
Yep. Harold, what do you see as a challenge out there looking forward in terms of the forecast?
Yeah, as I see it, I guess a couple things that the ahas to me, as I saw your piece, was how the Bay Area still is a hub for VC money. It's a hub for the tech worker. There was some growth there, actually grew 4%. So I think that there is a war for talent, especially for financial institutions, and it may not be as linked to the economy, but as B of A, Wells, and Chase are, those folks, as they're talking about the $25 an hour employee in 2025 at the teller line. I mean, I think for all of us, our employment costs are going to continue to drive to increase just to attract talent. We've all had to increase the amount of our merit pools and bonus, and people are jumping for additional dollars because it costs so much to live here in the Bay Area. People are willing to make that change, and so that's the challenge for us is keeping our talent to serve our members, and being able to make sure we have the very best talent as a modern employer within the Bay Area.
Absolutely. And there's some demographic trends that are maybe a little concerning as well along the same lines that, not only is there this struggle to find people, but the number of people that are available may be driving that not only now, but 10 years from now. And that's something that, economists and demographers are trying to really get set on what data really tell a story about where we're going to be 10 years from now, because that ultimately might then start to lead to more strategic decisions about location. And then those, as Marito was talking about, those kind of concentric circles, if tech comes back, how big of an effect will it be versus what's been true in previous cycles? Well, Harold, let's stick with you and let's talk about opportunities. Where does your credit union see opportunities looking forward, and why?
Well, we are a lender by choice. That's our lender first. That's why credit unions were created, and our model. We're not here to, as I think you alluded to, Robert, where some credit unions are doing well based off of having money, having liquidity. Our purpose is to take advantage of the time. We're seeing members that we have not seen as we fight for deposits. I think I heard Brian mention that we haven't done CD specials. We've had a pretty good variable rate CD that's pretty good, but now we're actually out attracting a pretty good chunk of deposits from our membership or from non-members, folks that have not given us an opportunity. We're advertising, of course, through social media, but we're actually going back to print because there's a different demographic that's going to want deposits along those lines. And we want to try to take those relationships and to expand those relationships into additional borrowing, into wealth management opportunities, but leading with CDs right now. I know we just had a CEO call that talked about don't focus so much on CDs as per se, but many of us are. You see the war for deposits in any publication. And once that relationship is here with us, we want to expand that relationship. One of the products that we like that continues to be the gift that continues to give is home values and our home equity line of credit product. If you use it, you pay for it. If you don't, you don't. We've saw 50% growth in that product in 2022. And I think that is a product that people will want to have in their back pocket, is to have the access to that non-liquid asset in their home, and those are products that we think leading with deposits, of course, first time in a long time, and following that up with things like people that are equity rich with HELOCs.
Yeah, and it'll be intriguing to watch how much those HELOCs are used versus their limit over the next couple of years as people are taking advantage of the equity, but being maybe cautious on their balance sheet. Marito.
Well, I agree with Harold. There's a lot of opportunity within the product set of every credit union. And, to many of our members and potential members, right, credit union really represents an opportunity to save, whether it's through a HELOC or even by refinancing your credit card into personal debt. with lower rates at your credit union. You know, a lot of folks don't realize that many credit unions are not here to make that, you know, buck, because we don't have shareholders, we have members. So we're here for you, and we offer very competitive rates on the lending side of things. And even the deposit side, right? Credit unions were not afraid to raise rates. We were all accustomed to zero bound rates, and we saw our members, you know, take advantage of the fact that they get to pay 4 or 5%. Well, we raised our rates to the right levels to make sure that members didn't have to go elsewhere to find competitive deposit rates. So all around, I think, you know, especially in this time of uncertainty and potential unemployment, you know, members can look at us to save money, whether it's even just comparing your own checking account and with your local bank or your national bank, whoever you bank with, and see how you can save by joining your local credit union. There's lots of opportunities to save here.
Thank you, Marito. Brian.
Well, I would have to say I would follow the same theme as my colleagues. You know, here we are, being our best credit union, and really just doing the things that we've done all along while the world changes all around us. But I would say that you know, with any period of tumult, there's opportunity, right? There's opportunity for our members, there's opportunity for us, and I would think that a lot of our members are thinking about things they haven't thought about in a long time. And maybe they're feeling like they need a safe haven for their monies. And certainly that's been us. We haven't had to prove it. Our actions over the years prove themselves. And I would agree with them that certainly a safe haven at your local credit union.
Yeah, one of the things that I've been asked a lot is how big of a problem the Silicon Valley Bank / First Republic situation is at the end of the day. And I think that nobody's really sure, based on the regulatory environment and not having kind of a really focal lens on some of those small to medium-sized banks. But I think the credit union difference is really about the idea that credit unions don't generally expose themselves to that kind of balance sheet or interest rate or credit risk in such a way because of the focus on the members, and hence that sort of safe haven. And it'll be intriguing to watch and see if we have another wobble if we don't see deposits shift from those institutions toward credit unions because of that safe haven characteristic. You guys did have a question for me, which was on federal debt. We are creeping up on this sort of weird time right now with respect to what might happen with the federal debt and some of the decisions our Congress has to make. It seems unlikely that Congress will not get a deal done to lift the debt ceiling. But we also have to think about two other items. And one is that we have a lot of spending in the pipeline from legislation previous to the congressional elections in 2022. So that as that spending rolls out, how the federal government pays for that against a maybe shrinking tax base in the front end as we go into a slower economic time period, and how that changes the debt market, specifically how government, our treasuries start to move on to the bond market to pay for that. And at higher rates, they're going to be at higher cost. And that interest cost is something that lingers in budget until rates go back down again, and you're able to kind of refinance and recycle that debt. And we could go on, we could have done the whole time on how treasuries work vis-a-vis other bond markets. But the point is that we do have to expect a little bit more burden on the government, regardless of getting this sort of short-term issue done with the debt ceiling. We still have to think over time, there's going to be more and more pressure on those, on our federal budget, based on what we already have in the pipeline to spend and how we're going to finance it in a higher rate environment. So watch for those angles also coming if we get a deal done before June 1st and get close to this weird time and then move forward. I wanted to share one more screen real quick with our audience, and that's about E-Train at the League. Angela Daly does a great job in providing these resources from the League. Check out E-Train at ccul.org to find out more. And Matt Rye is sort of our lead press person. He's got all kinds of great information about what's going on out there and was sort of the beginning of this process with respect to the Bay Area forecast and bringing us all together. So folks, check out that E-Train if you get a chance. With that, I want to thank you guys for making the time today and really providing your insights as credit union leaders. We are in a wild time, the last 6 or 8 months, and it seems like every time we're in a wild time, we say, oh, this has been as wild as it's ever been. We know there's been weirder times, but it seems like there's between geopolitics, economics, demography change, the aftermath of the pandemic, there's just a lot of moving parts, especially in the Bay Area economy that was kind of hit on all sides by the pandemic. We're still under that shadow effect. So it's the cool thing is that credit unions are a place that members can find safety. So thanks, guys. I really appreciate your time.
Thank you.
bet.
Thank you for the
Take care,
opportunity.
Robert.
Thank you all.
You bet.
Bye.